Okay, pull up a chair. If you're a junior trader sitting at your desk right now wondering why you keep losing money on what look like absolutely perfect COT setups, you are in the right place. Welcome to this masterclass explainer. Today, we're going to completely fix your framework. We are diving deep into how to integrate time and seasonality into your commitment of traders analysis. Because right now, you are probably trading with a massive blind spot. Let's get into the complete guide to temporal edge in gold trading. Let's start with a classic textbook mystery, all right? Picture this. It's May 5th, 2026. You pull up the COT report. Managed money net long is sitting in a massive plus 94,254. Your COT index? Screaming above 80. Swap dealers are massively short. I mean, literally every single indicator in your primary framework is flashing neon red, telling you this market is incredibly overbought and a huge correction is imminent. So you do exactly what you were trained to do. You size a standard short position, you place your stop, and you wait. And then, gold just grinds higher for 6 straight weeks. No way, right? What went wrong? Listen, your COT analysis wasn't broken, but you missed a massive, crucial variable. To figure out exactly why that May trade blew up, here's our addenda. 1. The temporal edge. 2. Mapping the gold calendar. 3. Using the collision matrix. 4. Adjusting your position size. And finally, 5. The almanac and the microscope. All right, section 1, the temporal edge, the third dimension of market analysis. So most traders out there are really only operating in 2 dimensions, price and positioning. But they are entirely missing the third critical dimension, which is time. And this brings us to our core concept today, the temporal edge. Simply put, this is the integration of intermediate timeframe seasonality with your COT positioning data to figure out the actual net directional pressure on the gold market. Look, in the microsecond time frame, markets are just random noise. But zoom out to the weeks to months time frame, which is exactly where the COT report operates, and human behavior drives the market. And guess what? Human behavior follows a very strict calendar. So what exactly dictates that calendar? Well, we have 4 overlapping seasonality cycles that actively govern gold. First, the Asian demand cycle. We're talking massive cultural and religious festivals. Second, the institutional flow cycle, which is basically just the mechanical portfolio rebalancing by massive funds. Third is the mining supply cycle. Think weather and operational variations in output. And fourth, the macro event cycle, driven by central bank rhythms. The absolute crucial takeaway here, when 1 billion people in India and China are buying physical gold for Diwali or the Lunar New Year, they are absolutely not checking the COT report first. They buy because the calendar says it's time to buy. Moving to section 2. Mapping the gold calendar, knowing the terrain. Before we can really rev up our high-performance COT engine, we've got to map out the seasonal terrain we're actually driving on. Watch how this timeline builds throughout the year. In January, you get the rebalancing rally. Institutions are deploying new capital, and folks are buying ahead of the Chinese New Year. Move into April, and boom, you hit the Akshaya Tritiya surge, which kicks off the massive Indian wedding season. Then we hit June, the dangerous summer doldrums, where liquidity basically vanishes. And finally, October brings the Diwali peak, which is historically one of the absolute strongest seasonal tailwinds of the year for gold. Let's zero in on June for a second, just to see how dangerous this terrain can be. It is historically one of the absolute weakest months for gold. Volume completely collapses as the Northern Hemisphere goes on vacation. There is no major cultural, physical demand holding up the floor. And because the market is incredibly thin, any quarter-end institutional rebalancing can cause massive, exaggerated whipsaws. If you get a bearish COT signal in June, watch out. That thin liquidity is going to brutally amplify it. Okay, section 3, using the collision matrix, when seasonality meets COT extremes. Now, this matrix right here, this is the ultimate tool. It's the absolute core of our masterclass today. This is how you actually make your trade decisions, because seasonality actively modulates your COT signals. Look at the top left. Say you have a bearish COT signal in a month with bearish seasonality, like June. That gives you an amplified bearish signal. Both forces agree, they are a tailwind. But now, look at the top right, a bearish COT signal during a bullish season, like October. That is a muted bearish signal. The physical demand is a massive headwind actively fighting your paper short. Down at the bottom right, bullish COT plus bullish seasonality equals amplified bullish. You only want to go to your maximum conviction size when the paper players and the physical calendar totally agree. Let's look at a direct side-by-side comparison to really cement this. An amplified signal is your textbook perfect setup. You get a washed-out bullish COT reading right in early January. You've got institutional New Year allocations plus pre-Chinese New Year buying. The engine and the terrain are perfectly aligned. You can comfortably trade full size.
Compare that to a muted signal. Let's say you get a bearish, heavily overbought COT reading hitting in late October. Yes, the paper traders are heavily long, but 1 billion people are actively buying physical metal for Diwali. That physical demand provides a massive floor that pure speculative positioning just cannot break. In that scenario, you absolutely must reduce your position size.
Which brings us right back to our opening mystery. May 5th. Why does your perfect short blow up in your face? Well, because you only looked at the paper. If you had checked the calendar, you would have seen that late April and May are the absolute heart of the Indian wedding season. So your heavily bearish paper COT signal collided head-on with neutral to supportive physical buying. The physical market completely absorbed the paper selling, which delayed that expected correction for weeks. Basically, you were driving a perfectly tuned engine straight into a muddy hill.
Section 4. Adjusting your position size, the sizing math.
We are moving from theory straight into practical execution now. Here is your explicit standard operating procedure, so you never have to guess your exposure. Step 1, calculate your base COT conviction score using your standard framework, looking at the index, the confirmations, the delivery data. Step 2, go to the calendar matrix we just learned and determine the seasonal adjustment factor for that specific month. Step 3, add those together to get your final adjusted score. This final number mechanically dictates your sizing tier. Whether you go in at core, conviction, standard, recon, or scout size, you let the math dictate your exposure. Minus 0.20. I want you to burn this number into your brain right now. This is the maximum seasonal penalty you will ever apply to your conviction score. For example, if you try to short a bearish COT setup right in the middle of April during the Akshaya Triti surge, you apply that minus 0.20 penalty. That massive reduction immediately drops your trade down 1, maybe even 2 sizing tiers. In a lot of cases, this specific mathematical penalty will drop your score so low that it completely keeps you out of the trade. It literally saves you from shorting into a total avalanche of physical buying. All right, final section, section 5. The almanac and the microscope, the integrated trader. Let's bring this whole explainer together by looking at the 2 main tools on your desk. Think of the COT report as your microscope. It reveals the fine structure. It tells you exactly who is holding the paper contracts right now. But the almanac, that's your seasonality. It reveals the macro rhythms and the predictable human behavior. It tells you who actually wants the physical metal out there in the real world. A trader who only uses the microscope sees the structure perfectly, sure, but they completely miss the rhythm. I want to leave you with this incredible piece of senior analyst wisdom, straight from our source material. The trader who ignores time is flying with one eye closed. The COT is the engine, but seasonality is the terrain. It makes perfect sense, doesn't it? You can have a literal Ferrari engine of a COT setup, but if you try to drive it into a seasonal swamp, you are going to get stuck. Every single time. So the final provocative question you need to ask yourself before you place your very next trade is this. Are you still trading with one eye closed? From now on, never, and I mean never, look at a perfectly structured COT setup without cross-referencing that calendar matrix first. Master this temporal edge, and I promise you, you will finally stop getting run over by the calendar. Thanks for joining me on this explainer. Now get out there, check your calendars, and manage that risk.